Hey, good morning, everyone. Marty Missouri here. June 20th, 2019, about an hour before the market opened. Thought I would share my thoughts with you this morning, update you on the chart. It's been a few days since we've done that. As you no doubt know, yesterday the Fed did not disappoint the markets. While it didn't cut interest rates, Jerome Powell, speaking on their behalf, announced that they are less patient than they've been. They've got some concerns, and they stand ready essentially to cut interest rates as early as July next month if they deem it necessary to support the expansion. Their dual mandate is full employment and 2% inflation. One could argue that they're close enough to their dual mandate to not have to even have this discussion, but they are because they see some cracks under the surface, and we've been seeing some cracks now for several months that I've reported on in here. So I guess you could argue for a Fed rate cut. It is exceedingly preemptive in my view. And as I've been hinting on the blog, and Jerome Powell all but committed to yesterday, it's really about the trade war and the existential risk that it poses onto the global economy. Right now, we're in a position where the economy is still okay. Conditions aren't screaming recession just yet. But nonetheless, the Fed is cutting interest rates and the market is liking it a lot. As I speak here this morning, we're looking at a really noticeable 1% move, 250 plus points in the Dow, 300 or 30 some points in the S&P. Jump right at the open. Kind of a delayed response, I guess, to yesterday's Fed uh, announcement or yesterday's move to Fed dovishness, if you will. So I don't mean to be sounding like a party pooper, but I'm not enamored by this rally. I'm not super excited. I want to help you understand what's behind it and help you put it into perspective. Because while we certainly may continue this move on up to and beyond all-time highs, in fact, this morning I think we're going to eclipse it, at least on an intraday basis near the open. It's not likely given the fundamental underpinnings in my view. The fact that the Fed is threatening to cut interest rates says that there's something going on that's not positive as it relates to the economy and the stock market. You know where I stand on the whole trade war. If we don't come to a resolution that eliminates the new tariffs and gets off of the tariff bandwagon going forward, I don't think we can have much faith in anything that moves up in terms of stock prices up in here. But if I'm right, why would stock prices go there at all? Well, I can tell you unequivocally, I'm not alone in that sentiment. And the folks who share that, for the most part, are not small players in the market. There are some very sophisticated investors who are sitting above these levels with a huge amount of short interest. What happens when I'm talking short interest in the stock market, it's the activity of selling borrowed shares, expecting to buy them back later at a much lower price, giving back those shares and pocketing the difference. So shorts believe that the market's going to fall. But if the market doesn't fall, if it rises and leaves them behind, they have unlimited risk because they sold at this level. They're going to have to buy it back at a much higher level and lose the difference, and it can be devastating. So when it looks like there's going to be an impulsive move higher and catch them sitting there, it's called a bear trap. They have to cover those shorts. And when they do, that's buying of stocks. It's happening in the futures market as I speak this morning, I assure you. And that exacerbates the upside move, and that can suck in a lot of people, make no mistake. Exactly 1 week ago today, I wrote on the blog, indeed, the notion that the Fed can rescue the market could fuel a real test of the recent highs. My best guess is, without a change of tack on trade negotiations, that would turn into an ugly bull trap. What I mean by that is as shorts covered, as the bears get trapped, it sucks in bulls. thinking that this is the beginning of the next great move, and it very well could be, but it requires something better on trade negotiations, make no mistake. I also said that the latest sentiment readings are generally not bullish, which means that there is definitely money out there to buy stocks, which would exacerbate a rally should the short-term technical pattern suddenly resolve to the upside. One of those short-term patterns is what's called a bull flag pattern. Notice we had this big impulsive move for 4 or 5 days right in here. And then if I draw a line up here and then look at this pattern here, what does that look like? That looks like a flag, right? And typically when you have this pattern, you have this big impulsive move, you have consolidation, and then often you get a big jump out of it. So this would be a rally should short-term technical patterns suddenly resolve to the upside. Now this looks like it's resolving to the upside. Remember, we have the shorts right here, they cover, and we get a move, and this flag pattern really does work the way it's supposed to. The next move could be as long as the actual original flagpole, which would take us way up here above 3,000 on the S&P, and that very well could happen, no doubt about it. Again, I will say, without the ultimately monster trade war headwind abating, we can have zero faith that the present expansion and thus the present bull market has the legs to last. That's still my position. That doesn't mean that we don't consolidate back up in here and that we don't get resolution ultimately and move solidly into all-time highs. When that is my thesis, believe me, I will be very happy to give that to you. Right now, I'm here to tell you that the big rally this morning is the result of, as I said here, a short-term technical pattern resolving to the upside based on what the Fed did yesterday, shorts covering, exacerbating the rally, and then sucking in the bulls. Now, I said back here a week ago that the sentiment readings are generally not bullish, and I was referring to what I think are the two most important. It's the individual investor sentiment reading, and it's the advisor sentiment reading. As for individual investors, as you can see here, the bullishness is 29.5%. That's up 2.7% over the last week. This comes out every Tuesday. I can virtually guarantee you with what we're seeing here this week, this is going to jump a lot by next Tuesday. Back at the beginning of this month, the bulls were at 24.8 and the bears were at 40.1. So as you can see, we've seen a market decline in bearishness and a pretty good increase in bullishness. The neutrals were 35.1, they're at 38.4. I think we're going to see a move from these two areas up to here over the next week. So that's not scary at all in terms of the individual investor, not the 29.5. We'll see what we get this next week. Should be big, as I keep saying. As for investment advisors, this one for my purposes has been absolutely excellent in terms of gauging near-term probabilities. So we had a small increase this week in the bulls. 50.5 is a move into the caution zone above 50%. Above 55% denotes elevated risk and the need for defensive action if you're a short-term trader. So this is moving up noticeably. Right at the end of April, right here at the beginning of May, when the market began to fall apart, the individual investors' bullishness was at 33.5. and advisors were at 53.4. So we're moving back into that bullishness. So anyway, so this is when I wrote a week ago that there was enough pessimism, it's because these numbers were both notably lower, and that's sucking money in. So again, this is that potential bull trap that I'm talking about. This is shorts getting covered, pushing the stock up, and then sentiment improving and money coming in. Again, without a fundamental catalyst pushing this market higher, and I think that needs to be a resolution of the trade war. These people are potentially going to get trapped up in here. And if we do get bad news on trade, if they walk away from next week's meeting and so forth, or say this is going to go well into 2020, then that's what I mean by bull trap. Then they get trapped. Shorts come in, sellers come in, bring the market down, and then these processes start all over again. while conditions are favorable, while the economy is still in expansion mode, we're not going to react to this in client portfolios in terms of getting defensive and so forth. But I do want to make you aware, as I keep saying, we are going to see huge volatility in both directions. Now, in closing, I'm just going to quickly run through the three technical indicators I like to show you here with this daily chart. Unbalanced volume measures commitment to the rally or to the sell-off, moves down by the number of shares traded in a down day, moves up by the number of shares traded in an up day. I like to explain that it tells me whether unbalanced stocks are being either distributed or accumulated. When it's sloping down, that means they're being distributed. When it's rising, it means they're being accumulated. So as you can see right in here, stocks were being distributed while the market was still rising. Same kind of thing happening right in here. It rolled over just as the market was rolling over. You want to see bullish divergences, not bearish divergences. When you have a sideways move here or an upward move, and this is down, that says that there's not real conviction below that rise. So you want to see this resolve to the upside as well if you want to get seriously bullish up here at these levels. In terms of underlying momentum, the moving average convergence divergence, as you can see, we had a bearish divergence when we rolled over there. We had a bearish divergence when we rolled over here. Again, this would be a divergent high. We want to see this break through and slope upward from this point before we get too excited from a longer term technical perspective. And then the same thing with the RSI, the relative strength index. You see the bearish divergence. We're still in a bearish divergence. Needs to resolve to the high side again before we get longer term excited about these levels right in there. So in summary, of course, we like what we're seeing here. My purpose here today is to help you put it into its proper perspective and understand that this big thrust higher that we're going to see this morning, in my view, is more about shorts covering and perhaps late coming bulls jumping into this rally, potentially getting trapped if we get some bad news on the trade front or some other exogenous news that comes in and upsets their apple cart, so to speak. And the technicals are suggesting that's where the risk lies right here. But again, of course, we will keep an open mind, and I'll keep you abreast of all of the developments as they occur going forward. Thank you as always for watching and listening. Talk to you again very soon. Bye-bye.